Hi, in this video we will be talking about the truth about debt. Watch this video to the end to learn why all debt is not created equal. Welcome back to the International CEO. Debt is a ubiquitous aspect of modern life, a tool wielded by individuals, businesses, and governments alike. It can be both a blessing and a curse, depending on how it's managed and utilized. In recent years, the discourse around debt has become increasingly polarized, with some advocating for its elimination while others argue for its strategic use. However, what often gets lost in this debate is the crucial distinction between different types of debt and their respective implications. Indeed, the truth about debt is that not all debt is created equal. To understand the nuanced nature of debt, it's essential to first define what debt entails. This definition, however, fails to capture the wide array of forms debt can take and the various purposes it serves. Broadly speaking, debt can be categorized into two primary types: good debt and bad debt. Good debt, as the name implies, refers to borrowing that is used to finance investments with the potential to generate long-term value or income. Examples of good debt include student loans used to fund education, mortgages for purchasing a home, and business loans to finance expansion or innovation. What distinguishes good debt from its counterpart is that it serves as a means to an end, enabling individuals or entities to acquire assets or skills that can enhance their financial position over time. Conversely, bad debt is characterized by borrowing that is used to finance consumption or expenses that do not contribute to long-term prosperity. Credit card debt used to fund lavish vacations, high-interest payday loans to cover everyday expenses, and excessive personal loans for non-essential purchases all fall into this category. Unlike good debt, which has the potential to increase one's net worth or earning capacity, bad debt often leads to financial strain and can impede progress toward achieving financial goals. One of the key distinctions between good debt and bad debt lies in their respective interest rates. Good debt typically carries lower interest rates due to being secured against valuable assets or associated with investments that offer promising returns. For example, mortgages and student loans often feature relatively low interest rates compared to credit card debt or payday loans. In contrast, bad debt tends to come with higher interest rates, exacerbating the financial burden on borrowers and making it more challenging to repay the principal amount. Another critical factor to consider when evaluating different types of debt is their impact on creditworthiness. Responsible management of good debt, such as making timely payments and maintaining a low debt-to-income ratio, can bolster one's credit score and improve access to favorable lending terms in the future. On the other hand, accumulating excessive bad debt and missing payments can tarnish a borrower's credit history, making it harder to secure loans or obtain favorable interest rates in the future. Furthermore, the psychological and emotional toll of debt can vary significantly depending on its nature and magnitude. Good debt, when used wisely, can instill a sense of empowerment and accomplishment, allowing individuals to invest in their future and pursue their goals with confidence. In contrast, the burden of bad debt often leads to stress, anxiety, and feelings of hopelessness as individuals struggle to keep up with payments and contend with mounting interest charges. Despite the clear distinctions between good debt and bad debt, the lines between them can sometimes blur, leading to confusion and mismanagement. For example, while student loans are generally considered good debt due to their potential to increase earning potential through education, excessive borrowing or pursuing degrees with poor job prospects can turn them into a financial liability. Similarly, mortgages, typically seen as good debt, can become burdensome if homeowners overextend themselves or purchase properties beyond their means. Moreover, the context in which debt is incurred plays a crucial role in determining its implications. For instance, taking on debt during a period of economic prosperity when interest rates are low and investment opportunities abound may be viewed more favorably than doing so during a recession or financial crisis. Similarly, the purpose for which debt is utilized matters. Borrowing to finance essential needs such as healthcare or education may be more justified than borrowing for frivolous or speculative purposes. In recent years, the rise of fintech and alternative lending platforms has further complicated the landscape of debt, offering new avenues for borrowing outside traditional banking channels. While these innovations have democratized access to credit for many individuals and small businesses, they have also introduced new risks and challenges, such as higher interest rates, opaque lending practices, and predatory lending behaviors. In light of these complexities, it's crucial for individuals to approach debt with a discerning eye and a clear understanding of its implications. Rather than demonizing debt outright, it's essential to recognize its potential benefits when used judiciously while remaining vigilant against its pitfalls. This entails conducting thorough research, evaluating one's financial circumstances and goals, and exercising prudence and restraint when borrowing money. Global economic trends and debt dynamics. At the macroeconomic level, debt plays a pivotal role in shaping the trajectory of economies and financial markets worldwide. The dynamics of sovereign debt, corporate debt, and consumer debt are interconnected in intricate ways, influencing everything from interest rates and inflation to currency valuations and geopolitical stability. Sovereign debt, or government debt, refers to the money borrowed by national governments to finance public expenditures and bridge budget deficits. While sovereign debt can be a crucial tool for stimulating economic growth and providing essential public services, excessive borrowing can lead to fiscal imbalances and sovereign debt crises. High levels of sovereign debt relative to GDP can undermine investor confidence, leading to higher borrowing costs and potential downgrades by credit rating agencies. The COVID-19 pandemic further exacerbated this trend, as governments around the world implemented unprecedented stimulus measures to cushion the economic fallout from lockdowns and restrictions. While these measures were necessary to prevent a deeper recession, they have raised concerns about the sustainability of public finances in the long run. Corporate debt, on the other hand, refers to the money borrowed by businesses to finance operations, invest in growth opportunities, or refinance existing obligations. Corporate debt can take various forms, including bonds, bank loans, and commercial paper, each with its own set of terms and conditions. While manageable levels of debt can help companies fund expansion and innovation, excessive debt can pose risks to financial stability, especially during periods of economic downturn or market volatility. In recent years, corporate debt levels have soared to record highs, fueled by low interest rates and a search for yield in a low-yield environment. This trend has been particularly pronounced in sectors such as technology, healthcare, and energy, where companies have taken advantage of favorable borrowing conditions to fund mergers and acquisitions, buybacks, and capital expenditures. While cheap debt has enabled many firms to weather economic headwinds and pursue growth opportunities, it has also raised concerns about leverage and debt sustainability in the event of an economic downturn. Consumer debt, including mortgages, credit cards, auto loans, and personal loans, constitutes a significant portion of total debt in many economies. While consumer spending is a driving force behind economic growth, Excessive levels of consumer debt can pose risks to financial stability and household well-being. High levels of debt relative to income can leave households vulnerable to unexpected shocks such as job loss, illness, or interest rate hikes, potentially leading to delinquencies, foreclosures, and bankruptcies. In recent years, consumer debt levels have risen steadily in many countries, driven by factors such as rising living costs, stagnant wages, and easy access to credit. The proliferation of online lending platforms and fintech innovations has further fueled the growth of consumer debt, making it easier than ever for individuals to borrow money with a few clicks of a button. While these developments have expanded access to credit for many underserved populations, they have also raised concerns about predatory lending practices, subprime borrowing, and financial exploitation. Navigating the complexities of alternative lending platforms. The rise of alternative lending platforms and fintech innovations has transformed the landscape of borrowing and lending, offering new opportunities and challenges for consumers, businesses, and investors alike. From peer-to-peer lending and crowdfunding to digital banking and cryptocurrency lending, these platforms leverage technology to streamline the lending process, reduce costs, and expand access to credit for underserved populations. Peer-to-peer lending platforms, also known as P2P lending or marketplace lending, connect individual borrowers with investors willing to lend money in exchange for interest payments. These platforms use algorithms and data analytics to assess borrowers' creditworthiness, determine loan terms, and facilitate transactions, bypassing traditional financial intermediaries such as banks. While P2P lending offers borrowers an alternative source of funding and investors an opportunity to earn attractive returns, it also carries risks such as borrower default, platform failure, and regulatory uncertainty. Crowdfunding platforms, such as Kickstarter and Indiegogo, allow individuals and businesses to raise capital from a large number of contributors in exchange for rewards, equity, or debt. Crowdfunding has democratized access to capital for entrepreneurs, artists, and social causes, enabling them to bypass traditional gatekeepers and secure funding directly from their supporters. However, crowdfunding campaigns are not guaranteed to succeed, and backers may risk losing their investment if the project fails to materialize or deliver on its promises. Digital banking platforms, also known as neobanks or challenger banks, offer banking services exclusively online or through mobile apps, without physical branches. These platforms typically provide a range of financial products and services, including checking accounts, savings accounts, debit cards, and loans, with lower fees and higher interest rates than traditional banks. While digital banking offers convenience and flexibility for consumers, it also raises concerns about cybersecurity, data privacy, and regulatory compliance in an increasingly digital world. Cryptocurrency lending platforms, such as BlockFi and Celsius Network, allow users to borrow and lend digital assets such as Bitcoin, Ethereum, and stablecoins in exchange for interest payments. These platforms leverage blockchain technology to facilitate peer-to-peer lending and borrowing, with interest rates determined by supply and demand dynamics. While cryptocurrency lending offers users an opportunity to earn passive income on their digital assets, it also carries risks such as price volatility, counterparty risk, and regulatory uncertainty in the nascent crypto market. Amidst the complexities of debt in today's world, fostering financial literacy and promoting responsible borrowing are essential pillars for empowering individuals to make informed financial decisions. By equipping individuals with the knowledge and skills to navigate the financial landscape, we can empower them to build a solid financial foundation and achieve their long-term goals. Financial education should begin early in life, ideally in schools, where students can learn basic financial concepts and develop essential money management skills. Incorporating financial literacy into the curriculum can help young people make sound financial decisions as they transition into adulthood, whether it's managing student loans, opening a bank account, or understanding the implications of credit card debt. Moreover, financial institutions and fintech companies have a responsibility to promote transparency, fairness, and ethical behavior in their lending practices. This includes providing clear and concise information about loan terms, fees, and interest rates, as well as offering financial counseling and support services to borrowers in need. By fostering a culture of responsible lending and borrowing, we can mitigate the risks associated with debt and promote financial well-being for all. Regulators also play a crucial role in safeguarding consumers and ensuring the stability of the financial system. Implementing robust regulations and oversight mechanisms can help prevent predatory lending practices, curb excessive risk-taking, and promote transparency and accountability in the financial industry. Moreover, policymakers should work to address systemic issues such as income inequality, job insecurity, and housing affordability, which can exacerbate debt burdens and financial vulnerabilities for many individuals and families. Thanks for watching. If you found this video helpful, please give it a thumbs up, hit that bell, comment, and subscribe for more content on the International CEO. See you next time.